What's up everybody? Gen X Dividend Investor here. In this video I'm going to tell you how I'd invest in dividend stocks based on what age I was, a process which can also be used to invest based on how close you are to retirement. And if you appreciate content like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. I'll kick this off by saying that I always try to give advice based on what I think will be beneficial to the majority of viewers out there, but it's important to recognize that everyone has their own realities, which I obviously don't know about. So never take what I say as gospel. I mean, I'm just some random guy on the interwebs who's passionate about dividend investing, but that doesn't mean that what I'll say will make sense for you. Okay, a commonly prescribed asset allocation strategy tells you to own a percentage of stocks equal to 100 minus your age, with the remaining percentage being in safe bonds. Like a 30-year-old should have 70% of their portfolio in stocks and 30% in something like US Treasuries. I used to watch a big finance YouTuber who was apparently following that strategy and was holding bonds in his 20s, but I thought it was a mistake. I would shy away from bonds until you're at least in your 40s or 50s, and I personally don't ever plan on owning any unless you can lock in some super awesome rates. So I'm not a fan of that asset allocation guideline, but since it's the commonly given advice, I figured I'd share. As interest rates go up, then US Treasuries become more compelling, so maybe I'll change my mind. I mean, locking in a 30-year Treasury at 10% would be pretty sweet. There are some good iBonds out there these days at about a 10% rate, but you're kind of limited to being able to invest $10,000 a year in them. So let's quickly talk about iBonds. iBonds are a type of US government bond that earns interest based on a fixed rate plus an inflation rate. The fixed rate remains the same throughout your bond's life, but its inflation rate component changes twice a year and is based on CPI for urban consumers. iBonds are a good place to park some cash that you'll need in the next 1 to 5 years. Like maybe you're going to make a down payment in a couple of years and you have some cash now, so instead of storing it in a savings account, you might want to look into iBonds. Are they a good investment? Well, given rates are so high, then they seem pretty good. I believe they will adjust the iBonds rate down in November, so you might need to act fast since I released this video on the 29th, but I'm not sure about that, I'm just guessing. Anyways, let's pretend you got in at 10% and you bought the full yearly limit of $10,000 worth. That means you would get $500 of interest earned over the next 6 months, but you cannot cash in your bond until you've held it for a year. I mentioned your 6-month rate because the rate's only guaranteed for 6 months, and then after that it can go up or down. If you cash in your bond before you've held it for 5 years, you'll lose the last 3 months of interest earned. Bonds are meant to be held long-term, and rates will change over time. iBonds have a maturity of 30 years. They carry a 20-year original maturity period, followed by a 10-year extended maturity period. There are several ownership caveats with iBonds. First, they cannot be cashed for 1 year after purchase. If a bond is cashed in year 2 through 5 after purchase, the prior 3 months of interest are forfeited. 2, there is no interest penalty for cashing in the bonds after 5 years. 3, generally speaking, iBonds are exempt from state and municipal, but not federal, income taxes. Owners can pay taxes on the interest earned annually, at maturity or when the bond is cashed. So if you keep your $10,000 bond for 30 years, you wouldn't lose any interest penalties, but there is no guarantee your rate would stay the same. That can make it difficult to know how much you can make investing in iBonds over a long period, though that's true for most investments. Anyways, you can buy up to $10,000 worth of iBonds annually through the government's Treasury Direct website. You can purchase another $5,000 with your tax refund, upping the annual total purchase amount of Series I bonds to $15,000 per person. Another type of bonds to be aware of are called EE bonds, which is fixed for the life of the bond. EE bonds offer a guaranteed return that doubles your investment if held for 20 years. There is no guaranteed return with iBonds. If rates are low, EE bonds seem more compelling to me, but when rates are high, like now, then iBonds look sexier to me. Something to think about anyways. I personally am just going to stay focused on my stocks, which I believe will appreciate along with will increase their dividend each year, but I encourage you to research iBonds more to see if they make sense for you. Now, some people would say that my portfolio of only stocks is too aggressive, though that feels strange to me because I'd classify myself as a super conservative investor given that I focus on blue chip dividend stocks. In theory, a stock bond portfolio should have less volatility and appreciation than an all stock portfolio, depending on what stocks you hold. Anyways, one potential flaw with the classic stock bond asset allocation strategy is that it was created a long time ago when people weren't expected to live as long as they do today. The longer you live, the more you want to make sure that your portfolio can get the appreciation that stocks tend to provide, and going too early into bonds can stunt your returns potential, which means stunt your retirement spending potential. Another asset allocation that some people use is called the 15-50 rule, which says that if you think you have more than 15 years left to live, then your portfolio should consist of 50% stocks and 50% bonds cash. The 15-50 rule was liked by both Benjamin Graham and John Bogle, so it's interesting to me that it hasn't caught on more. And again, remember that your personal situation and risk tolerances can allow you to deviate from the guidelines. Like if you have health issues in your 20s, then you might invest differently than someone who's super healthy in their 60s. Or if you have a family, then you'll probably build up more of an emergency fund than someone who's single. Whatever you do, just remember that investing for your future is important at any age, and it's okay to change your investing strategies as time goes on. With more risk can come more reward, but it can also mean bigger losses, so make sure you research things and always invest intelligently. Common sense says that you should take more investing risks when you're younger, since you should have a longer time to correct any missteps you might make, plus you're probably investing with smaller amounts of money. As you get near to retirement, you often have more money to invest, but also less time to recover from losses, so usually people get more conservative. Okay, let's start with people in their 20s, aka people who are probably 30 to 40 years away from retirement. Some of you 20-year-olds will live frugally and invest intelligently, and you'll be able to retire sooner than the norm. In fact, I bet a much higher percentage of people watching this video will be retiring sooner than the average person out there. In your 20s, you're probably focused on paying down student loans, and hopefully you're avoiding taking on credit card debt. At this stage of the game, you should start building an emergency fund, especially if you have a family or have a job that isn't too secure. If your parents can act as a safety net for you, then you can relax on your emergency fund and pile more money into investing. A big advantage that people in their 20s have is time and the ability to compound their investments for decades. They should focus on more aggressive growth stocks, dividend or not. My guess is that technology will have the best long-term returns, so I've told my kids to prioritize those companies, and I'd suggest the same to people in their 20s and 30s. So companies like Apple, Microsoft, Broadcom, Google, Amazon, and stuff like that. You could also look into smaller cap stuff and see if you find some companies that you really like. Now, one thing I think is a mistake that I hear some experts push is that younger investors should avoid conservative blue chip stocks due to their limited growth. I think that if you can buy great companies on sale, then it's always worth investing, depending on your goals and needs. So stocks like Johnson & Johnson, Realty Income, Procter & Gamble, Pepsi, Visa, Costco, Goldman Sachs, JPM, Caterpillar, General Dynamics, Home Depot, AbbVie, Pfizer, Starbucks, etc. I'm long most of those. A diverse portfolio of blue chip stocks will probably perform similarly to the SP 500 and should outperform if you can buy when things are on sale, and getting decades of returns like that is all it takes to do well. Just own quality assets for a long time. People at almost any age could simply go with broad market ETFs and avoid single stocks, but that comes down to you and your needs and motivations and such. Just remember that most professionals underperform the overall market, so going with indexes is probably your best long-term bet. In your 20s, you need to check to see if your company has a 401k match or an employee stock purchase plan or an HSA, and then dig into the details of those opportunities to see if they're worth being a part of. Generally, the answer is yes. If you don't have access to a good retirement plan at work, then consider opening your own Roth IRA. For most folks in their 20s, I would avoid high-yield stocks unless I needed the income now, like maybe if your job wasn't secure or if you simply wanted more cash in the present. And if I did need more cash flow, then I'd look to tobacco stocks, oil and gas stocks, telecom stocks, utilities, maybe some covered call ETFs and stuff like that. REITs might also be compelling, and I prefer to hold them in my retirement accounts to simplify tax stuff. Some people wanting income now might also consider BDCs and MLPs. And obviously you could further juice your portfolio by spending some time doing options or getting a side hustle. And some people might want to invest a small percentage of assets in far riskier plays. Like maybe you really believe in crypto, so okay, put in 5 or 10% of your portfolio into assets like Bitcoin or Ethereum. I wouldn't advocate for more than that, as I think your best long-term odds are weighted towards investing in quality companies that you think can continue to flourish, but a little bit of spice here and there should be okay. If you're really conservative, then you could hold some utilities, kind of like the bonds of your portfolio, recognizing that utilities aren't as safe as treasuries, but do tend to be safer than most stocks. One thing I wouldn't do is let the macroeconomic conditions affect too much how you're investing. I mean, you never know how the market is going to do in the short run, and regardless you can't control it, but you can control investing in solid companies at good prices. Invest like you plan to own your companies for at least a decade. Another recommendation I have for people at every age is not just manage their portfolio, but also manage their costs. Half the equation for becoming wealthy is on the expense side, not just the income side and investing side. I like to use spreadsheets to manage to a budget, but there are lots of tools you can use. Be aware of all your recurring monthly costs, recurring annual costs, and big one-off costs. Once a year, go through your Visa bills and debit card and such, and do a deep dive to see if your expenses are trending as you'd expect. It's a pretty eye-opening exercise to review your expenses from the last year. You might find that you're spending way too much money eating out, or maybe you spend a lot more money than you realized on your pets, or whatever. Maybe you don't need 5 subscriptions to different streaming services, and maybe just 2 or 3 is enough. Cutting down on your expenses mean you can invest more and save more or whatever. The fastest way to increase your net worth is to manage both the money coming in and the money going out. Trust me, keeping a tab on your expenses is half the battle. Okay, then we go into the next stage of life for people in their 30s, where some people have homes, some are married and have dual incomes, careers are progressing, and some folks have kids. And don't put off investing for your kids. I recently talked about how to invest for your kids in a video called Reviewing a Subscriber's Dividend Portfolio, October 22, where I talked about kids' custodial accounts. Too many people I know have made the mistake of thinking that they'll invest for their kids a bit down the road when they have more time and money. Don't make that mistake of putting it off. Just start small, but be sure to start. And if you're lucky, then maybe your grandparents or parents will help your kids with college. I'm not that lucky, but maybe you are. If you do make the mistake of putting off planning for your kids' future, then trust me, your kids will suddenly be in high school and you'll realize that you've not invested a dime yet. Anyways, there can be a lot of variance of where people are in their 30s. Like, some people are single, some are job hopping, some are struggling to find or hold a job. Some people are grinding to push ahead in their career, and others are taking time off to explore the world. The reality is that most people don't invest at any age, so don't worry about what you haven't done and instead just focus on where you want to go and how you're going to get there. But don't put off investing. Okay, your 30s are when many people are saving for a down payment on their first home. This is when most people start making more money, so they can also dial up investing a bit more, even though expenses are also going up. At this stage of the game, you're probably 2 or 3 decades away from retirement, so remaining focused on stocks which will give you the best total returns makes most sense. And just like in my 20s, I'd still be fine with classic dividend stocks like J&J, Costco, McDonald's, Procter & Gamble, Realty Income, Pepsi, Coke, Visa, and stuff like that. I'd also target higher growth stuff like Apple, Microsoft, Google, etc. I actually still feel that Apple and Microsoft are still too spendy right now, even with a pullback in tech, but those stocks are hard to find cheap. Like, you'd need to go back before 2015 to get Microsoft at what I'd consider a cheap price relative to its earnings at the time. Okay, and as you transition into your 40s, you should be really focused and aware of retirement, and make investing a top priority, as well as keeping a lid on your expenses. You're probably making a lot more money now, so don't make the mistake of letting your living expenses go up as your money goes up. That's almost what everyone does. They get the Mercedes, they get the bigger house, they get more name brand crap, and they eat out more. Sure, treat yourself now and then and travel and such, but if you can avoid the trap of spending more as you make more and instead funnel your cash into investing, well, it will make your future so much brighter. At this stage of the game, you're probably making good progress chipping away at the principal on your mortgage. Hopefully you can really push your retirement contributions, ideally in your Roth. You also should be building up your emergency fund a bit more. And then as you roll into your 50s, you might also be able to start transitioning into higher yield things if your retirement is getting closer. Like maybe you sell some of your Apple and Microsoft in favor of things like ExxonMobil and Chevron, maybe some sin stocks like Altria, British American Tobacco, or Philip Morris, maybe some telecom stocks, maybe some utilities like Duke Energy or Southern Company. All those stocks I'm long in. And maybe you've owned those stocks from day one because you needed some income security along the way, and that's okay too. At this point, you should have a very clear plan of when you're going to be able to retire and what you'll need to do to get there. You should have a pretty good idea what your expenses are going to be like and what sort of cash flow you'll need to retire, factoring in all your income sources. And maybe you can accelerate the pace of your retirement if you're willing to downsize your house and maybe expat internationally so you can retire sooner. Of course, your health is always an X factor, and you could be fine now, but something could hit you out of the blue, so having more of an emergency fund might be worth considering. As you get into your 60s, you're probably going to get Social Security as well as Medicare if you're in the US, or whatever the equivalent pension plans and healthcare benefits are for retired workers in whatever country you're from. Some people will choose to go super safe with treasuries or CDs, but I personally am more comfortable remaining in conservative quality dividend stocks. My stocks tend to outpace inflation and appreciate more, but that's not a guarantee, so you gotta do what makes sense to you. At this stage, you're focused on income preservation and sometimes capital preservation, and many dividend investors have transitioned into higher yielding stocks. If your portfolio allows it, you'll probably stay in some dividend growth stocks as well to keep gassing your portfolio value. Many dividend investors will be forced to sell some shares of their stock if they're short on income. I did a video called When Dividend Investing Falls Short, where I show you how a calculator in my spreadsheet tool estimates how many years a dividend portfolio could last if you were selling off part of your shares each year to cover a shortcoming between your expenses and how much dividends your portfolio was making. And again, you can always potentially gas your income with options or side hustles or whatever. In your 60s is when people are really thinking about future generations and how their portfolio could be passed on to them. Finally, when you get into your 70s, you may have RMDs to deal with if you have a traditional IRA. If you have a Roth IRA, then you don't need to take RMDs, so you can leave your portfolio to grow for your heirs if you don't need the money. Regardless of what age you are now, it's awesome that you're watching videos like mine because that tells me that you're serious about raising your financial literacy. Hopefully you can get your kids or relatives or friends into investing as well. Find a dividend video that you found inspiring, whether it's mine or someone else's, and share it with one other person you know. You could literally be changing their life and all their future generations by that single sharing act of educating them to possibilities that they probably aren't aware of. Bottom line, live frugally and enjoy life, and while the best time to start investing was probably when you were younger, the second best time to start is usually now. It's never too late to head down a better path, regardless if you've put it off. Okay, I hope you enjoyed that. If you're interested in getting access to my spreadsheet product, then go to patreon.com and search for Gen X Dividend Investor, and then if I have any seats open at the Aristocratic King tiers, then sign up, and within a few hours I'll email you instructions on how to access my spreadsheet, along with we'll share some private tutorial videos on how to use it. I tend to sell out of seats quickly when I open them up, but just refresh my Patreon page every so often, and I'm sure you can snag one if you're interested. I limit access to how many Patreon aristocrats and kings I'll allow because of the time each one takes for me to support. Anyways, now I'll shout out my newest Patreon aristocrats who managed to sign up since my last video. So thank you Orlando T, Ryan N, Coach Jim, Stan, Kofi Benedict, Dan Hitman7, who signed up for an entire year, giving him a 10% discount, Lacus 2002, who also signed up for an entire year, and thank you Benji, who signed up for an entire year. Aristocrats gain access to my dividend portfolio tracker spreadsheet, which I use in lots of my videos, and they get special access to various private channels on my Discord, including one which lets you watch my videos before I release them publicly on YouTube, as well as lets you vote on which thumbnail I should use, and of course you get more direct access to me. Finally, I urge everyone to join my free Dividend Discord chat server, which has thousands of dividend investors on it from around the world. Regardless of what you do, please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.